Thanks to all of you for joining us this morning. We really appreciate your time and look forward to a really interesting, very compact, hopefully concise conversation. We've got some great speakers. We've got some great guests. We're going to have a quick conversation, and then hopefully, if we push through this expeditiously, we can we might even get to some questions. I'll come back to that in just a sec. Let me start off with a little gratitude. First, you see these names up here to CREO, to GEF, to Gratitude Railroad, Meloy Fund, obviously, that's us, Pegasus, and Systemiq. Thank you all for co-hosting and making the opportunity available to your networks to learn a little bit more about what we're up to. Howard Fischer mentioned from Gratitude Railroad at one point mentioned to me that, it's rare that anyone ever goes back, midstream to look at what actually happened, especially with these small pilot funds like this one, and which sparked the idea for this call. So thanks for the inspiration, Howard. I'm going to give you a quick introduction, and then we're going to learn a little bit more about Meloy, about what we've learned, and then we're going to hear about some reactions and what this little experience means for the community. In short, we're here for two reasons. There's a crisis and there's an opportunity. Small-scale fisheries across the developing tropics and the communities that depend on them are teetering on the edge of what I would call a potential humanitarian crisis. What happens when we outfish the coastal environment? Globally, fish stocks are overfished. We all know that. We also have underinvestment in coastal fishery recovery, which have left most of them poorly managed, poorly protected, and degraded, which affects the ecosystems and jeopardizes the food security and the livelihoods of millions of people. And so while we think about biodiversity as a conservation organization, we think about livelihoods and the well-being of local people, we also have to recognize the compounding impact of climate change and the potential for catastrophic displacement and climate migration. So enabling people the privilege of thriving where they were born is increasingly a critical phenomenon for all of us. And that's where we get into the nature of this existential crisis. Of course, we're also here to talk about an opportunity. And this is an opportunity that we began to see 6 or 7 years ago to bring private capital and to bring public funding and philanthropy into small-scale fisheries in countries like Indonesia and the Philippines in order to help finance the transition to sustainability. And in that regard, we envision and have envisioned and are starting to see what we would call a triple bottom line return. Returns for people, returns for nature, and returns for our investors. So by way of quick intro, let's talk a little bit about the places we're investing. Why do these places matter so much? It's important to know about where in the ocean we're talking about. So we're talking about territorial seas, commonly referred to as coastal waters. Territorial seas are a UN designation from decades ago, before there were exclusive economic zones. And this is that little zone just up to 12 nautical miles off coastlines. These territorial seas make up only 6% of the ocean, and yet this is where the ocean's highest concentration of biodiversity intersects with the greatest human need. Nearly 500 million people directly depend on small-scale fisheries, most of which are found within these nearshore areas. So let's just assess the value of this resource. This is where you'll find 100% of seagrass beds and mangroves. So the blue carbon ecosystem is here. This is where the vast majority, potentially 90+% of ocean-related jobs are found in coastal fisheries. 83% of coral reefs, one could argue 70 to 80% of all marine biodiversity, let's say all known marine biodiversity. 40% of global fish catch comes from this area. Many people assume all the fish comes from industrial fleets. Far and away, the most fish eaten by people is caught in these local waters, because so much of the industrial fleets provide fish that turns into feed for animal feed for agriculture. So if we're considering what areas of the ocean to invest in, there's no question that the best possible return on investment would be in these territorial seas. But that's also the problem. There has been so little investment, philanthropic or private, in recent decades, while we've seen a dramatic decline in the average biomass in these waters. We calculated with CEA, California Environmental Associates, that somewhere between 5 and 15% of all ocean philanthropy over a 10-year period was invested in these territorial seas, and perhaps even less invested in addressing overfishing in these local waters. Well, you might ask why. It's pretty obvious. Socially and politically, it's a lot easier to protect big parts of the ocean that have almost no population and that are far away from the coast. But because of the density of biodiversity and its importance for local people from a food security and climate resilience standpoint, we just don't have the luxury of ignoring this part of the ocean anymore. A crisis is brewing. And so we've been working hard with a whole host of partners and many of you to do something about this. So I guess the last little challenge we face is really the funding for small scale fisheries, the funding for territorial seas is actually just a fraction of the sector, let's call it sector Sustainable Development Goal number 14, oceans, life underwater, which gets the least global philanthropic and public funding support. So we're talking about a fraction of the fraction, and yet we've already established where all the value is. That's the real opportunity here. So this lack of investment makes it virtually impossible for coastal nations, most of which are in the developing tropics, to be able to allocate the resources necessary to sustainably manage these waters. And so we've seen negative trends in biomass globally. And we know that poor and ineffective management leaves these waters vulnerable to overfishing, destructive fishing practices, agricultural runoff, sewage waste, and pollution. So if we want to protect blue carbon, if we want to build climate resilience for up to 1 billion people, if we want to safeguard biodiversity, and if we want a triple bottom line return, we realize we have to start doing things differently. 6 years ago, RARE thought we could begin to make a change here. Impact investing was on the rise, but no one was really thinking much about oceans, or very few people were. Very few had any allocations in their portfolios or strategies or the ability to evaluate risk in this area. And many had concluded there were simply no pipelines. There just wouldn't be enough deal flow to justify creating a fund. I guess we were dumb enough to try this. We set out to make a difference. And I'll leave the rest of the story to my colleagues. Dale Galvin was the chief operating officer at RARE for over a dozen years. Veronica joined him in helping us at RARE build the Meloy Fund originally. They have left to create Deliberate Capital, and they are now under contract to continue this journey outside of RARE, managing the harvest period of the Meloy Fund. And so we're going to ask Dale and we're going to ask Veronica to share with us what they've learned. Over to you, Dale. Thanks for joining.
Great. Thanks, Brett. So as we were just talking about, we started the Meloy Fund to solve a few problems, namely the ones that we just reviewed: the lack of investment in SDG 14, the lack of management of coastal ecosystems and small-scale fisheries, which were all leading to a tragedy to commons, essentially. So, there's no incentive in a common pool resource like oceans, and especially the coastal part of the oceans, to fish or interact with nature responsibly or sustainably. And the result is this vicious cycle of overharvesting stocks and overfishing. So as per this slide, the cycle is you overfish, you have fewer fish to catch, lower quality fish, smaller fish. And so to feed your family or to make a living, you have to increase your level of effort, your catch per unit of effort declines, and you fish more aggressively with more destructive techniques or with more effort, and therefore you have more overfishing. So that's the vicious cycle that we created the Meloy Fund to help address. So next slide. So the good news is that there are opportunities for investors, for coastal communities, for nature, if we address both of these gaps in both management and in investment. So let's take the first one. On the management side, this is a chart made by analysis by University of California, Santa Barbara, where they look at what happens to a fish stock under different management scenarios. So each one of those colored lines, I'm not going to go through each scenario, but each one of those colored lines represents a different management scenario for a data poor fishery. And you can see that the more aggressively you reduce fishing pressure in the short term, you can see this dip, then you have a bigger recovery in the long term. So if you reduce fishing effort, there's a cost to that in the short term, but in the long term, you actually have much more fish yield and economic value for the communities and for everybody in the supply chain. And we actually calculated that in the two countries in which the Meloy Fund works, Indonesia and the Philippines, two large fish producing nations, 24,000 islands between them, highly climate vulnerable coastal communities that work in this sector. Between business as usual and where you could get to under sustainable management, over a 10-year period, you could create $4 billion of value. So that's how much money is being left on the table through inefficiencies and through poor management at the local level. Next slide. The other piece of the opportunity is the value creation in the sector. So you have to still get through this dip in this J curve. So obviously we can't ask poor coastal communities to fish less. We have to find ways of getting through this transitional period to get to sustainable management without costing communities income in the short term. And so based on research that was done by groups like University of California, Santa Barbara, other NGOs, and our own experiences working at the local level with fishing communities, with local governments, with national governments, with companies, we knew that there are opportunities to create value, which would allow us to improve business opportunities and incomes while not increasing fishing pressure or reducing fishing pressure. And those are the solvable problems you can see here on the slide on the right: fragmented and disaggregated supply chains, lots of inefficiencies and waste. So in some cases, we're seeing up to 30% of fish catch wasted because of a lack of cold chain or proper handling techniques, lack of infrastructure, lack of value-added products. So we're always selling the lowest commodity product in the market. So there's a lot of opportunities here to address this dip in the J curve. And that's, to realize those opportunities both on the market side and in the management side is why we created the Meloy Fund. So next slide. So as I mentioned, it's a fund focused on these important coastal ecosystems and fisheries in Southeast Asia. So just Indonesia and the Philippines, the Coral Triangle, the heart of biodiversity and the oceans. And there are these triple bottom line goals to improve the livelihoods of 100,000 fisher household members, to put 1.2 million hectares of seascape under improved management, and to demonstrate also that there's an opportunity to make money here, that there's an opportunity to make a financial return commensurate with the risk in this market. And we did that with the help of lots of great investors, partners, donors, some of which are on the call today. And they were all very catalytic in helping us launch the Meloy Fund and getting investment in SDG 14 as a sector going. So with that, I will hand it over to Veronica Yao, as Brett mentioned, our head of ESG and impact at the Meloy Fund, to provide an example of what this approach looks like in practice.
Thanks, Dale. It's great to be here with everyone today. So today I'll be sharing about the sustainability journey of our first investment in Indonesia. So PT agreed the best seafood. And through this case study, we hope to illustrate some of the key lessons that we've learned since the inception of the fund. Next slide, please. So PT Agrita is started by husband and wife team, Anita and Nicholas. So back in 2018, they were one of the few seafood processors that specialize in octopus. They were well known for their the quality of their product. They had close relationship with the fishers, and they do not buy below a minimum size, but they were limited by the amount of capital that they have to start their own processing facility. And that limits what they can do in terms of market access and ensuring they meet the requirements of the buyers. So next slide, please. So Meloy Fund's investment initially was to support PT Agrita to have their own processing plant, to increase the working capital for sourcing. At the same time, the technical assistance facility of the fund provided grant funding to get their new factory up to international standards and to support improvement in financial management. But the support didn't stop there. When the pandemic hit and Agrita wasn't able to source from fishers for a particular period, the grant funding was used to provide emergency food aid and safety kit to the fishers to ensure that they can still meet their daily needs. Next slide, please. So where PT Agrita is at today, they continue to improve on their food quality standards, but more importantly, the US buyer that the fund introduced Agrita to has requested for sustainably sourced octopus, and the TA facility is now supporting Agrita to initiate a fishery improvement project, a pathway towards the Marine Stewardship Council certification, which is the gold standard in sustainable seafood market. In terms of revenue, Agrita is on track, given the pandemic, given the time that it took to set up the processing facility. And I think more importantly, is the lessons that we've learned along the way with Agrita, which we'll go through now with together with you. Next slide. So lesson number one, while the Meloy Fund invests kind of like in the mid-level supply chain, right? So a lot of these seafood processors like Agrita, our impact metrics is actually at the fishery level. So in terms of the number of fisher households positively impacted and the hectare of sea safe under improved management, as shown by Dave just now. So here are some of Agrita's fishes. As you can see, the fisher kind of lie on their front, kind of duck their head into the reefs and look for octopus all day long. So it's pretty hard work, and sometimes it could be dangerous. But when you speak to the fishers, there is a sense of pride of being an octopus fisher when they show us their gear, when they talk about how they search for octopus. And for the fisher to the right, catching octopus has allowed him to be bankable. He has a bank loan now that enables him to build his own house. So these relationships between the investee and the fishers, without which we won't be able to assess the level of ESG risk and the interventions that are necessary at the fishery level for us to be able to achieve our impact metrics. So these relationships between the investors and the fishers is something that we highly value. So while it has been good for the fishers, what about for the fishery? So like a lot of these fisheries in Indonesia and Philippines, this octopus one is unregulated and unreported. So there's barely any data, as well as then any form of management, which brings us to lesson number two, engaging the local government. So this is a photo of a multi-stakeholder workshop that we conducted last November, bringing together the local district and provincial government, academia, local NGOs, Agrita and their fishers together to discuss about the priority that they would like to see through the FIT, as well as the work plan and activities that they would like to hold towards sustainable fishery management. And before this workshop, the local government didn't even know that octopus contributed to a big portion of the revenue in the province. So they are very supportive of this FIT. So we think it's really important to have this kind of knowledge and learning and exchange on the ground, because sustainable fishery management is a multi-stakeholder effort. And could we have done it from day one of the investment? Probably not. It really takes building that relationship with Agrita, that step by step, getting their factory up to international standard, getting the buyer who's demanding for sustainable seafood, and getting all the multi-stakeholders that are necessary to be at the same table and speaking the same language to kickstart the pathway towards sustainable fishery management. So lesson number three, other than just looking at the needs of our investees, it's also really important to look at the needs of the community, because the fishery is theirs to begin with. So here we partner with the local District Ministry of Marine Affairs and Fisheries to combat IUU fishing by getting all of the fishers and vessels registered. And in the coming year or so, we'll be looking at forming fisher associations involving the fishers and their wives, looking at alternative livelihood and financial literacy training to ensure resilience for the fishers. So lesson number four, while a lot of processors, they normally collect production data. So there's barely any biological data. So here, the FIP has, through the FIP, we've hired an enumerator working together with the fishers to start collecting the weight, the length, the gender, and then the catch effort of the octopus to feed into a national stock assessment that will be conducted by the Research Institute together with other NGOs like Blue Ventures and Sustainable Fisheries Partnership. At the same time, we're trying to map out the fishing ground, where the fishes are going and how much fish they're catching where. And through these vessel monitoring systems that also have a safety feature that serves the fishes well if they have emergency at sea. So next slide, please. So lesson number 5 really talks about capturing the value added market. So rather than just exporting frozen octopus, why don't you cook it, chop it, marinate it, whatever it takes to be able to gain that higher margin? Because as we know, sustainably premium is still quite hard to get. But what we want to do is through these value added and new products that our investees are coming up with, that they can return part of the margin to the fishers, either through the fisher associations for community benefit or directly back to the fishers. And higher margin also means less octopus need to be caught. And that's a win-win for both people and nature. So at the end of the day, what we really learn is the importance of having different types of capital to serve different needs and to be in it in the long run and through the tough times with our investees, and how important that is, like going all the way down the supply chain. So the gentleman to the left is Pak Wandi. So he's one of the key suppliers of Agrita. And what he told us was, when the going gets tough, all of the buyers left except Agrita. And that's why he's still here today, supplying to Anita, to Agrita, and getting all of his fishers to participate in the FIP. And that is what we think sustainability is about. It's about relationships, it's about meeting people where they're at and going through the long haul with them to get to achieve sustainable fisheries management. Thank you.
Thank you, Veronica. Thanks so much. That was a great update and series of lessons learned. And thank you, Dale. So we've heard from the Meloy Fund about what their experience tells them so far, and how we can continue to advance the prospects of ocean investing, especially in the territorial seas. So let's open this up to a conversation. We'll eventually get to some of the Q&A that's coming up in the chat. Thank you all for participating. Lots of great comments going on. We have just some terrific guests here that we're going to bring in right now. First up, from the Builders Initiative, we have Peter Bryant from the United Nations Global Fund for Coral Reefs. We welcome Batista from Gratitude Railroad, as I mentioned earlier, Howard Fischer from Systemiq, Jennifer Ring, and from CREO, we have Jason Scott. Dale and Veronica are also going to be available to join us. So I think we can probably take down the screen. We'll get everybody, or at least Peter. Why don't you join us, and I'll kick this off with you first. So first of all, welcome, Peter. It's great to have you here.
Yeah, thanks for having me, Dale. I think I was asked to reflect on some of our learnings from our Meloy Fund investment. And I guess maybe the first thing I'd say is Meloy Fund was our first impact investment in the ocean space. And since then, we're now up to more than 30. And so I think Meloy really catalyzed the development of a sector for us that we believe is really important to put investment capital into. And it's not always easy, as I think has been alluded to already on this call, but really important that we're driving capital into this space, just as the other sectors are for the Sustainable Development Goals. And I think, Brett, as you called out, Life Below Waters received less funding than any other SDG. So in addition to all the great philanthropic capital that's out there, we need to start to be able to mobilize money in a much more meaningful way on the investment side. And I really appreciate Meloy for being the first out of the gate in that respect. In terms of learnings, I guess the first I would offer, I've got 3. The first would be patience. And that sort of is inherent as an investor in a number of different ways, but especially in an emerging sector like oceans, patience is critical all along the way. And I'll point to the fact that you need to have patience in terms of how long it takes to raise capital. You need to have patience in terms of how long it takes to recruit talent. You need to have patience with respect to how long it takes to find adequate deal flow. And then you need to have patience with respect to return on investment and impact in the water, which ultimately as an impact investment is what you want to see. And every single one of those things has required the investor community, not just for Meloy, but for all of these things that are operating in this space, to not only be comfortable with that, but to understand that there will be delays, and that doesn't have, that has to do with a lot of externalities and other issues that aren't necessarily within the abilities of an institution like RARE to control. Second for me is tolerance for risk. And obviously tolerance for risk is associated with the patience, as I mentioned, for all those other issues that that you deal with. But as investors committed to impact, you're going to see a variety of different levels of tolerance for risk, even within the impact investor community. And so it's not, there are, 5 flavors of this. Literally, there are going to be multiple shades of gray in between black and white with the investor community and tolerance for risk. As foundations, the foundation sector needs to have the greatest tolerance for risk. Our job normally is to give away money. So if we're going to be making investments, I wish the foundation community would remember that as they go forth and look at investments, because with expectations of returns being an important consideration, so is impact. And because of the risk factors and the emergence of this sector from an investment perspective, I think tolerance for risk and maybe as funders being a little bit more creative about the variety of tools that we can use. It's not just grants or investments, but there's also recoverable grants, forgivable loans. And I think the investor community has a variety of financial tools that they can use to essentially meet the investment where it is in terms of their comfort levels. And I would encourage more to do that and to think that way. And then final learning, I think, is just around the importance of readiness of these businesses for investment. And I think Dale, did a great job early on, and it was really with the encouragement of, I think, another investor in the initial investor group, to develop a technical assistance facility for the businesses that were part of Meloy. There's all this great work that RARE can do with its own skill sets in these 2 countries in terms of policy work and enabling science and trying to really understand impact. But there's also business development readiness that needs to happen in advance of these companies being capable of taking an investment and then reporting back financially on what it's doing. And I won't be able to speak to all the things that the technical assistance facility did, but Meloy didn't start out that way. It came as Dale and team began to understand and encounter issues associated with, getting these businesses ready for handling investment dollars. And I think it was a really important, flexible fix that they made along the way.
Thank you, Peter. That's nearly comprehensive of the whole experience. So thank you for those insights. I remember when we went out and asked our first investor, one of the first investors, Jeremy Grantham, we said, Jeremy, you've been supporting RARE for many, many years. We've always guaranteed you a 0% return on your philanthropic grant. In this case, with a guarantee from the DCA at USAID, we're guaranteeing you the worst we're going to do is to lose 50% of your funding. And he said, well, that's definitely an improvement. So, but he was willing to take that risk. So from the experience of one of our first investors, Peter, to someone who's been looking at the whole system, and they're aptly named Systemiq, Jennifer, can we bring you in here and ask you a question? Essentially, from your purview, having Systemiq created the Blended Finance Task Force, you've been bringing people together all over the world at Davos and other gatherings to talk about this. My sense is that the talk to action ratio has been pretty outstanding. I mean, pretty high. That in fact, there's so much more talk over this last decade than actual deal flow and investments. What do you think it's going to take? What does your team at Systemiq believe it's going to take to get more action in the field, to get more of this kind of work done?
Thank you. You're right. There certainly is a lot of talk. There does seem to be a growing recognition that blended finance has a crucial role to play in mobilizing private investment, of course, for the ocean, but also for people and planet at large. And you're right, Systemiq has very much been in the mix. As you said, we launched the Blended Finance Task Force, which mobilizes capital for the SDGs and for climate. And we're actually a technical partner of the Global Fund for Coral Reefs as well, which is, of course, a blended finance vehicle. But the problem, I think, is that there are still very real inefficiencies in how these vehicles get designed. And there simply aren't enough of them to go around. So I think thus far in the order of $200 billion has been mobilized for sustainable development through blended finance. So you'll excuse the pun, but in the context of global finance, that really is a drop in the ocean. And it does beg the question, why isn't more capital flowing at scale to these types of solutions? And as you say, where should we be focusing? I think there are a couple of reasons here. I'm going to focus on a few. The first, and I think this echoes Peter's final point, is this piece around pipeline. It can be challenging to find investable projects that are sustainable, resilient, nature positive in emerging economies. And we need much more from concessional capital, from innovative financing mechanisms, from technical assistance to develop those projects, to build nascent sectors like blue carbon, to scale regenerative business models. Seaweed aquaculture is always the example I come back to here. There's so much possibility out there, but we do need more from that concessional capital, and we need it urgently because, of course, there's really a lead time in building that investable pipeline. The second piece I would point to is the evidence base. Understandably, private investors are hesitant to come into blended finance vehicles if they don't have robust and comparable data that essentially reassures them that these vehicles are going to achieve what they set out to do. So of course, there's a financial returns track record dimension here, but there's also really a piece on impact. And I think not just in the ocean space, but beyond, there's much more that we can do to get better at developing robust, harmonized metrics and methodologies for demonstrating climate impact in terms of both mitigation and adaptation, biodiversity impact, and of course, socioeconomic impact as well. At Systemiq, we actually worked with the 1,000 Ocean Startups Coalition to develop an impact KPI framework for the ocean, which is publicly available online for anyone who might be interested. And we think that goes some way to beginning to address this challenge, but there, as a community, there is still so much more that we can collectively do. The third point, and again, I don't want to repeat Peter too much, but I think there is something on how concessional capital is getting used and whether it's getting used as catalytically as it could be. Of course, the thesis of blended finance really is that public and philanthropic capital is being used to crowd in private investment. So what that means in practice is that ideally we should be seeing philanthropy, for instance, really acting as a pathfinder for innovation, scaling solutions that other investors aren't willing to back, and really being very additional in their approach. And then by the same token, ideally we would be seeing DFIs and MDBs really coming into blended finance vehicles as the de-risking or subordinate portion of those vehicles. We don't always see it playing out that way today. And then the final point actually is a more hopeful one, I think is so resonant of this entire discussion that we're having, which is blended finance can be so bespoke, can be so complex, can come with its own transaction costs, but we know that there are examples out there, many of them very successful, many of them offering us many learnings. I know we're going to hear more about the Global Fund for Coral Reefs today. I think we should be asking ourselves, how do we do more to take what's working, to scale and to replicate these models in new geographies, in new marine and coastal ecosystems, and in so doing to really unlock blended finance at scale for the ocean and for sustainable development more generally.
Love that. Love that. Really well said, Jennifer. Thank you. And it's interesting to think about what we're sitting here talking about a very early fund. Peter mentioned it as a first investment. It's a $22 million impact investment fund, the economics of which are extremely challenging. And yet what we know we need is billions and billions of dollars following a similar pattern. So what's exciting about this little sort of interim report and sharing is that, we're entering the harvest period. We've got, several more years to go, and we see this huge opportunity. And yet we also know there's so much more to be done and then so much more potential as a result. So speaking of where these things can go, I mean, some of you may know that as Dale and Veronica sort of spun out of Rare, Dale created Deliberate Capital and was hired to then run the Meloy Fund on behalf of Rare as a fund manager. Because of that experience, Pegasus and the Global Fund for Coral Reefs approached Deliberate to help manage the Pegasus Global Fund for Coral Reefs emerging, hopefully $500 million fund. So at Rare, we're really proud of this notion that taking the big risk and getting a whole bunch of other people to join us, holding hands to take these risks, enabled the creation of some let's call it social capital and intellectual capital that might be able to be part of the DNA of what is now arguably one of the largest funds for the ocean in the world. And so Yaba, I want to bring you in now and just ask you, tell us a little bit about the role of blended finance in scaling investments for the ocean. And how does the Global Fund, first of all, congratulations on the Global Fund for Coral Reefs and your recent launch. And how does this experience inform what you're doing there?
Thank you so much, Brett, and thank you for having me here in this great webinar. First, I would like to say that everything that Peter and Jennifer have said in terms of lessons and next steps is crucial. And these are things that we are taking on at the Global Fund for Coral Reefs to develop our blended finance approach and therefore our implementation process. I actually think that everything that Peter particularly said on all the lessons related to investment in the oceans are critical for scaling up the investment in for the ocean and marine conservation. I do think that patience is definitely essential. We are already seeing that in the Global Fund for coral reefs. But I think piggybacking on what Jennifer said as well, blended finance, I feel, is crucial for ocean investment because we know it is riskier to invest in the ocean. We know that these are new business models, and blended finance does offer us the opportunity to help de-risk for those investments to actually become a reality. And that's what the Global Fund for Coral Reefs is actually aiming to do. The fund was actually launched in September 2020. So we are about 2 years old. And as I was just mentioning, we use blended finance to facilitate what we call an innovative reef positive investment ecosystem, in which we use a diverse set of financial tools to design, incubate the risk and unlock that not only private, but also public sector financial flows for coral reef positive impact. The GFCR is truly an amazing coalition. And here I would like to highlight that we have partner governments like the government of the UK, Canada, France, and Germany that have joined this coalition, and particularly are donors to the grant fund of the GFCR. We also have philanthropies that were essential also in the design of the fund, particularly the Paul G. Allen Family Foundation and the Prince Albert of Monaco Foundation were essential also in the launch of the fund and were our two earliest philanthropies. And now we have been joined actually by the Builders Vision. So thank you, Peter, for your great support to the GFCR, and also by Bloomberg Philanthropies. So this coalition continues to grow. Of course, it is a coalition that includes the United Nations, particularly the UN Capital Development Fund, UNEP, and UNDP. But we are also, of course, this coalition includes the investors. And in this regard, it is really great to be working as part of this process with Pegasus capital advisor, and now also with Dale and Veronica as part of that team. We think we're actually quite lucky to have them now in our wider GFCR team. Sorry, Brad, we kind of like took them from you, but rest assured that all the lessons from the Meloy Fund and the work that you at Rare did together with Dale and Veronica, those are incredibly important lessons for us to carry over the scaling up process that we are aiming to do at the GFCR. But how do we accomplish this, and what is our model in the Global Fund for Coral Reefs? So we focus on 4 main pillars that are basically the basis of our theory of change. First, we focus on protecting the most resilient reefs around the world, because these are the reefs that are going to help us repopulate reefs in the near and long-term future. Second, we focus on transforming the activities that currently are degrading the reefs and turning them into reef positive activities. So this is where a lot of these new business models come in place. So turning that into new opportunities for the ecosystems and also for the people to safeguard their livelihoods and also generate income for them. Third, we do know that protecting the reefs and transforming these negative activities and addressing the drivers of degradation is not going to be enough, because degradation has already advanced a lot. Climate change is already here. So we know we need to restore coral reef ecosystems as well. So this is the third pillar of our work. And last but not least, our fourth pillar focuses on recovery. And this basically is honing in on making sure that communities are essential as part of this whole process, and where we help them recover from shocks like climate change and the COVID pandemic. I mentioned before our reef investment ecosystem, and we basically right now have 2 main instruments that we are using to anchor that ecosystem. The first one is the Grant Fund of the GFCR, which is situated and managed by the United Nations, part of this coalition, and that's where I sit. And then we have the Investment Fund, which is the one that is managed by Pegasus, and specifically by Dale and his team. So as mentioned before, the role of the Grant Fund, again, is to de-risk, incubate, provide concessional loans, guarantees, and technical assistance to develop these new business models for the ocean economy that would then have positive effects on the reefs. And then on the Investment Fund, this is a fund that is focused more on equity investments, and they have a 3-pronged approach to deploying those investments. They're going to be focusing on sustainable ocean production with a focus on aquaculture, mariculture, and fisheries, hospitality with, of course, a focus on ecotourism. And then the third pillar of the investment fund approach is the circular economy and pollution management, which focuses on the collection, sorting, recycling of waste with a particular focus on plastics, wastewater treatment facilities, and reducing agricultural pollution in general. So that is, in a nutshell, what we are hoping to do. And I think Jennifer mentioned it very well. We need more GFCRs around the world to focus on the ocean economy. Right now, the amount of investments and resources that are being mobilized are really, really low. And we do see ourselves as a demonstration fund that can continue to carry that flag that the Meloy Fund already has been carrying, and help us continue to scale this into the future. So thank you so much, Brett, and happy to answer any questions.
Hey, thank you, Yaba. We really appreciate it. And in terms of any regrets you may have or we may have, forget about it. We are so excited to see where this thing has gone. In fact, you saved us from having to do Meloy 2. So you were welcome. And given all you've added to that portfolio, we wish you the best of luck, and we'll be cheering you and Deliberate Capital and Pegasus on as you go. In fact, we hope to find ways to partner and collaborate with you and keep this whole community growing. So thanks, Yaba. With that, I want to turn to my old friend Jason Scott, who's got one of the greatest networks of philanthropists and impact investors ever. He's an early player in this space. And Jason, the question to you is really, as we think about this, everything we're talking about is going to require many more people getting off the fence and getting involved. As Peter was calling them to action, to take greater risks, to break down the divide between the chief investment officer in the family office and, the chief grant maker, or to get the principals to understand that they can use their money multiple times, but in fact, they'll get a better return, as Dale outlined in the beginning, if they use some philanthropy on one side to boost governance and then bring in the private capital, so that we're not just creating more effort, we're creating more sustainability. This is all super complex. What's it going to take to get members of, let's say, CREO, this amazing network you've helped build, investing where it really counts, where the biodiversity is in the emerging markets?
Well, first of all, thank you, Brett and Rare, for having me join. When I was with Encourage Capital, you guys were great partners to us, and working with Dale and the team was one of the most fun things we did while I was there. And also thank you, Peter, for being incredibly supportive of some of our first investments in your various roles. We used to call Peter the cod father, but we weren't doing cod, so salmon father? I don't know. It's kind of awkward. So I guess three quick things. I think one is, you teed up a softball, obviously, but one thing I would point out about both the work that we did at Encourage, which was funded by Bloomberg Philanthropies and the Rockefeller Foundation on the research side, was it helped us at Encourage create an investment thesis. And it also helped us spend philanthropic resources on project development. And I think, just like you're increasingly seeing in other parts of the clean energy world and climate world, I think in the seafood world, I think having philanthropic resources to build pipelines and to develop projects, to work on the ground with local communities, with nonprofits, with government, is an incredibly important way to kind of tee up and catalyze the type of commercial investment opportunities that thankfully, one thing that has changed a lot in the last few years is that capital is actually looking for. So if you look at the proliferation of oceans and seafood focused fund managers, and the amount of capital that is coming, not just from kind of multilaterals and concessionary capital, but the amount of pure commercial capital that's coming into the sector, you can see that kind of all of that kind of grant making has actually created a really fertile environment, not just for commercial investment opportunities, but for commercial capital to come in, which was what ultimately we need to scale some of these companies and projects and solutions. So I think first is the need for just pure philanthropic risk capital to build pipeline and theses. I think the second is we obviously need to have more transparency. I think that's the root cause reason for this session. And Howard, I appreciate you pushing us towards it, because if you want people like Gratitude to come in to these investments and into these opportunities, they need to know what's worked and what hasn't. And I'll just give one super quick example, which is, we had a thesis that we developed around vertical integration of seafood companies. We made two investments. One worked really well, one didn't work really well. The thesis was correct, but actually the kind of understanding of the underlying company was incorrect, right? And so how do we share that information? How do we share what we learned? And we were able to take from those first two investments a much larger swing at a vertically integrated seafood company. And actually, in my current role at RRG, we're the owner of the third or fourth biggest wild caught salmon business in Alaska, which was bought through a vertical integration strategy, partnering with very commercial hedge fund type capital based on all those lessons learned, right? So if you don't tell the story of the research, the thesis, the success, the failure, then you don't get to, I think, what the outcome is, which is, again, crowding in commercial capital that has impact. And then the final thing I just say quickly is flexibility. The only thing I can guarantee is that none of these funds being raised will do what they said they were going to do. Not because they didn't try, but because things change. The market changes, there's a recession, there's a governance issue, interest rates go up, people switch from cow's milk to oat milk or whatever the equivalent is in seafood. But I think that if investors can hold the managers and the companies accountable to the outcomes, even if the situation changed, and be flexible, I think we can still have great impact. But I think if you're coming into the space, you just need to know that if you're in a market-driven environment and a biological-driven environment, we own a company that buys and sells crab in Alaska. Guess what? No crab anymore. You have to be flexible and find other ways to get the outcomes that you're looking for, both commercially and in terms of impact.
I think that last point is particularly significant here, Jason. I like to say that, you know, the difference between investing with in private investors and investing with philanthropists is private investors give you what you would call in the nonprofit world an unrestricted grant in exchange for potential returns and all the flexibility you need to return their money. And grants tend to be assessed not based on outcome, but based on the fealty with which you implement the plan you wrote 3 years ago. And that's just a hell of a challenge if you're doing anything risky. So part of this risk is to be able to get to the principals, the philanthropists, the investors, those with the capital, to be able to say, look, if this is risky, what that means is we don't exactly know how we're going to get there, but we're going to do our damnedest to do so. So you're betting on talent, you're betting on a team, and then you're going to get out of the way and let them do what they do and keep focused on the outcome. You know, so I wish we could fly that flag more frequently. So thanks for mentioning that. So last, over to you, Howard, before we open this up to Q&A. So you have a I'm going to ask you basically a similar question, and that's you created Gratitude Railroad. You have a whole network of fellow investors. You get together. You started off as like sort of a little, you know, investment circle, and now it's sort of becoming an enterprise. We started this off with this point about a crisis and an opportunity. It's not easy to get people in the United States or in Europe to invest in something as esoteric and far-flung and risky and informal or extra legal as coastal fisheries. And yet we know the ROI for the planet is way higher than anything else we can do, potentially. So how do you bring your people there? How do we bring more investors off the sidelines?
That's it's an interesting question. We met many years ago, and you told a similar story, which was fascinating and incredible, and the opportunity to protect fisheries and harvest profits for fisheries with investor capital and blended capital is pretty amazing. But as I sat here and listened, and it was really a very fascinating discourse by everybody, informative and empowering. It's complex, and I think part of the problem is that complexity, right? We're dealing with small countries that are far away that nobody's been to. My network in particular is interested in hands-on and involvement and engagement and supporting, not something that we can really do halfway around the world. The idea that there are philanthropists involved, which is wonderful and important, and we need that capital. The idea that there are regulators and government agencies involved, also the kinds of things that we wanted to avoid when we built Gratitude Railroad, right? We're thinking, how can we just invest directly? I think what you have here by that partnership that includes Pegasus, a very well-known, very respected, very successful, traditional private equity firm, I think that's a key, right? That brings additional, with all, again, full due respect to everything you guys have all done, that brings another level of investor respect and import. And I think that's the kind of thing you can do. And I would love to learn more and share more, and then bring this back to the gratitude community, even though we have historically only invested in the US. You're on mute, Brett. You're on mute. You're still on mute.
Unmute. Someone is muting me. Are we good? Can you hear me? Okay, thanks. So really appreciate that, Howard. And I think you've identified something really interesting, and that is, what's the relationship between the blue chip established private equity and venture capital community and all the startups? That market, what's the M&A market, or what's the facilitation market. We've just created this scenario where little nonprofit working in far-flung places, sets out to do something risky. It works, thankfully, after many, many years. And all of a sudden, this can become part of a template for a much bigger investment. How do we make that happen again? What does that look like? Because one thing that's going to be very difficult to replicate is the idea that a fund with hundreds of millions or billions of dollars is going to take the risk to put boots on the ground, so to speak, out in, outside of Jakarta, outside of, Buenos Aires, to be able to understand, to basically walk into an office and rebuild the books to understand what the underlying value of the company is in order to reduce the risk enough to make an investment. And so one of the things we learned early on was Fish Forever, which was the governance improving side of the nonprofit RARE, where we wanted to set our original vision was, let's improve governance, let's get local communities on board, and then let's bring in private capital to sort of close the deal. There were very few places where we found that the private capital was deployable, given that far and away, almost all of the communities with whom we worked and the Fischer folk with whom we worked were extra legal. So there was almost no overlap originally, which shocked us, so it disappointed us. And so there's still a whole layer of investment opportunity at the bottom of that pyramid, which calls to an even riskier future development and a riskier profile for investors. So we've only begun to scratch the surface of what the risks are and the opportunities are. So well said, and thank you. Listen, we are at the hour. It's 11:59, and we had wanted to get to a robust Q&A session, but I think what we've been able to achieve here is at least a quick and dirty look back at the first 6 years of the Meloy Fund as we enter the harvest period. You've had a sense of what investing in small scale fisheries at a pilot level can do to help influence the field, something we're very proud of. You've also seen some of the challenges and pitfalls, not just for those trying to invest, but for the communities themselves, for the fund managers, and then of course for the philanthropists and investors who want to see this sector, pull itself up by its own, bootstraps. Lots of learning, lots of opportunities. I hope this isn't the last conversation we have like this. Those of you who do have questions, we have recorded them. You have sent them. You can also follow up with us at info@rare.org. If you want to learn more about Meloy Fund, just Google Meloy Fund and go to meloyfund.com. And of course, you're more than welcome to continue to connect with us at rare.org. Finally, to Systemiq and Jennifer, to Yaba and the Global Fund for Coral Reefs, to Builders Vision and Peter Bryant, Gratitude Railroad and Howard Fischer, Jason Scott and the CREO family, and then of course the stars of the show, Dale Galvin and Veronica Yao. Thanks to each of you for your time and your talents. Let's keep doing this innovative and risky work. Cheers, everybody. Thanks for tuning in.